Now we turn our attention to Europe and looking at what's happening abroad and what are some of the issues that will continue to reside in the system. And that's why we talked about in segment 2 when we were looking at car manufacturing and how obviously Germany is a big part of that of the car manufacturing side. Those pressures will start to show up and are showing up in some of the German data. And that's something that we're going to have to watch, because when we look at BMW and Mercedes, they've talked about how they've had to reduce capacity, or they will have to reduce capacity if they can't get their fill of semiconductors that we've seen hit in Volkswagen, Toyota, Ford, and GM. They'll be kind of that next shoe to drop in general. But before we get into that, we have to look at, some of the industrial production that was expected in the Eurozone in general. So the industrial production for the whole area was expected to be down 0.8%. It came in down 1.6%. Industrial production on the year over year, that was month over month. Year over year was supposed to be down 0.2%. Instead, it came down 0.8%. So again, as we looked in December, we were coming into that slow point, and now that has just accelerated through January in general, which is again why we keep talking about some of these problems. But then on the positive side, when we look at like French unemployment rate, the unemployment rate for Q4 was expected to be at 9.1%, came in at 8%. Mainland unemployment came in at 8.9% versus 7.7%. Came in at 7.7% versus 8.9%, which is a positive when you consider what they were able to do. They were able to avoid another lockdown, which helped mitigate some of this expected impact that was going to come into the system overall. But with that being said, there are some net negatives when we start looking at what's happening in Germany. So German survey expectations were expected to be at 59.5, came in at 71.2. Which again, that is a positive. But then survey current situation came in at 66.5. Came in at 67.2, negative 67.2 versus a positive negative 66.5. So the expectation is that the future is better than my current situation, and they're starting to plan accordingly for that, which is a net positive. But how do we get to the other side with, the EU 27 new car registrations was down 24% in January. And we're seeing, the Eurozone construction output was down 3.7% in December, was down 2.3% year over year, as we saw that acceleration to the downside heading into January. Now, when we look at the backslide in general, the industry and trade business expectations continuing to move lower, where transport and logistics business expectations, that 6-month forward look, continues to move lower. So some of them are showing better, and others are showing worse. And that's where we keep getting this friction between which is going to win out. And it comes down to how much of a benefit can we see from stimulus versus CapEx spend and some of these other movements that again remain this overhang as how much can Europe get back to normal, given they still have lockdowns, they still have restrictions, and there's still some shakeout as to British exit trade flow, which has been hurting the UK as people have moved into other regions. Then when we look at the industrial production, you can see that downshift as we headed into the end of the year, never able to get back to where we were on pre-COVID. We had that push into year end, on the holiday side, and then we had that industrial production starting to slow. And we just don't see much recovery through January as we head into the beginning of Q1. And this is just looking at, who drove some of that reduction. So when we look at some obvious ones, but the biggest one is France, Italy, and Germany on the lower end, on the percent compared to 2019, where we have some of the others, which are, obviously Greece, Poland on the positive side, but who has a larger component of GDP math when you're thinking about the weightings of general growth. And it's the ones that recorded that negative growth, especially France, Germany, Italy. As Italy, they officially have Draghi as their prime minister. The question now will be, can they get back to normal? Can they stimulate more? Germany actually had a positive bond issuance, which is the first time since last year. And it's going to be interesting to see how do other countries price off of that, because Germany pricing at a positive, not a negative rate, maybe that opens up Lagarde to do more to try to stimulate and can weaken the euro more, or is this we're starting to see those inflation expectations price in? Now, when we look at Eurozone composite PMI versus Eurozone GDP, you can see just where some of this pressure is and remains in the system. And that's why we keep talking about that composite PMI versus those GDP numbers, because PMI remains in a depressed state. It's still below 50 on an aggregate level. Some bright spots. Services remain down, keep it surprising to the downside. Manufacturing has surprised a little bit to the upside, which again helps offset some of the services, but net, it's declining in general, which again is showing just where that pain is going to continue, especially when we think about an increase in commodity prices, an increase in pricing in general, which again will show up in a lot of these data points, because again, Germany is a car manufacturer. That is one of their biggest components, and when we look at cars, that remains to be seen as we see additional pressure overall. Now, when we look at that German expectation of economic growth, the survey was at 59.5. Actual for Feb came in at 71.2. So we see that sharp drop that we talked about in January. Now we're starting to see some of this normalization in Feb. I just am concerned about how much of that can be realized given some of the pitfalls that we've been highlighting. Now, obviously, these are companies that know their own books. They're seeing the order flow. They're seeing some of these adjustments, which would help pull PMI higher. So we'll have to see how much of this gets realized in some of the official numbers, because Germany so far is expecting a lot more. And while France, Italy, and Spain continue to lag behind a bit, France picking up just because they were able to avoid that third lockdown, seeing a little bit more of those GDP growth numbers, which has helped insulate a bit and can maybe help the Eurozone in general. When you see Europe, the European numbers given Germany and France might be able to surprise to the upside. But with those surprises to the upside comes core inflation drivers. And this is something where I am all about inflation and seeing it in the system. So this is one that we have to pause for a minute and look at, well, what drove it? Because Q4 and especially December into January, there was a VAT tax adjustment. So we have to factor in the value-added tax that was reduced in the end of 2020 to help put more money into people's pockets. That has now expired, which has pulled up some of these key components that have been depressed. So that's why we have to think about, okay, well, obviously this is one time. Is this trend going to be up? Now, I'm going to say yes, just because of the way the most recent German auction went, and it went from negative to positive. You could say that it's a reflection of this number, but this is a look-back number. So I'm saying that someone, or large individuals or investors, are taking this information, looking at where inflation expectations are based on commodity pricing, based on GDP growth, and they demanded a positive, not a negative number in order to take those German bonds. Now, given it's still below 1%, I'm not saying it's a huge issue, but when you look at the holistic side, it was a big jump from negative to positive, and it was pretty deep into the positive territory if we, all things considered. So this is going to be something to watch, because Germany is obviously the biggest country. Most bonds price off of German debt. So if Germany's gone positive, what does that mean for Italy, France, Spain? And is that going to increase interest expense and hurt the ability of some of these countries to continue to stimulate their economies and do more as you start to see this tightness, because the deficits continue to rise, stimulus continues to be issued, and this is going to put additional pressure on their markets overall. So that was a quick, it was a little light day or light week so far on European data. So we'll talk more about this next week when we get another slug of information coming out in general. And in our next segment, we're going to shift over into the fun times of Asia, and we're going to look at some of the key components when we're thinking about India and just Lunar New Year impacts in general.